NIL, a term that we've been hearing all over the marketplace over the last couple years, and it is leading to college athletes getting some of the craziest deals that we have ever seen. What were once college athletes that couldn't get paid anything legally are now getting hundreds of thousands to millions of dollars in yearly income. However, there is a part of this that absolutely nobody is talking about. The fact that the tax implications on this are absolutely brutal, and I'm pretty doubtful of how much help these athletes are getting in it. What's up, guys? My name is Aaron Shebloski. I'm a former Division I football player, and I just sold my first business for multiple six figures, and now I'm transitioning into the world of financial planning and tax strategy. As a longtime economics student and studying the code after passing a couple of the licensing exams, I'm going to be launching a firm that specifically helps 1099 contractors lower their tax bill and increase their investments. If you guys are interested in this type of content, make sure to subscribe. I put new videos out every single Wednesday. At the end of this video, you will have a deep understanding of how NIL athletes get taxed, some of the little things that they can do to fix it, and what some of the problems are in this industry right now. We'll first go over how much income they're getting and how it's getting taxed, if it's being regulated properly, and then what some of these people can do to fix it. So to start, how does this money actually get taxed? Is it as if they're a business? Are they on a W-2 at the school? How does this actually work? Now, although most of this information isn't actually public, from what we can tell, it seems to be that these people get individual 1099 contracts from either the school or the fund that's paying them or different businesses that are giving them NIL deals. Which means that at the end of the year, they will be filing Form 1099 NEC, equaling non-employment income. Essentially, they're not tied to some job. They don't have to show up every single day at 9 a.m. and leave at 5 like your typical employer might, but they are getting paid for certain services that they provide. And their scholarship rules are still tied to the same with the school, same things. They can't do certain things so they can lose their scholarship. However, this payment is different. Now, I don't see that the tax bill is getting talked about very much for these people. However, with the structure of a 1099 contract, you can be getting absolutely grilled in taxes. Here's how. The nature of 1099 income is that you owe 15.3% self-employment tax on every single dollar that you make. If you ever received a W-2 pay stub before, you've noticed that there's roughly a 7.6% tax on everything that you bring in for things like Medicare and Social Security. Now, when you are a contractor, you are your own employer, so you have to pay the 7.6% that your employer pays and the 7.6% that the employee pays. And this is actually a common thing. A lot of people think that running a business, you're going to get a ton of tax breaks being an entrepreneur, which can be true, but actually if you don't take advantage of them, business owners can get grilled in taxes. And for 1099 contractors, it's a very similar story. On top of this 15.3% tax, they're still subject to all of their state and local taxes as well as federal income tax. Obviously, they pay sales tax and things like that. If for whatever reason they own property, they'll owe property tax, but those are completely separate from this. That is the structure of how these athletes should be getting taxed. And because their income is coming from different streams, I presume, say from different companies that give them certain deals for certain sponsorships, as well as the fund that's paying them, it could be very confusing for them to keep track of all of this money. And one of the biggest issues that I see is that there has to be commingling going on. And if you guys don't know what that word means, it basically means you are mixing your personal and your business finances. Now, this is normal for a 1099 contractor because they're a person, they're a contractor, they're not a business, but this causes big problems. Basically, because of this, what's going to happen is every single dollar that reaches your bank account is going to get tracked as income, and every single dollar that leaves your business account is going to be seen as personal because you don't have a business. And because the funds are commingled, the IRS is going to be very quick to say these expenses are personal, they're coming from your personal account. This in no way is a deduction in the pursuit of business, as seen commonly talked about as things like Section Code 162A, which if you don't know just means that anything that is ordinary and necessary in the pursuit of income can be written off for a business owner. Now, I personally do not know the inner workings of how these colleges are managing this for people, but what I can say is that if everything is being done properly and the athletes are filing their income taxes properly, there is a huge problem with the fact that they're going to be paying close to a 30 to 50% tax bill. A lot of times closer to 50% because their athletes' income is so high, they're going to get pushed into really high tax brackets. And once again, they almost have no deductions. Now, it's very probable that a lot of this income is under the table. To be honest, I don't know. Nobody can ever know what income is getting slid under the table. We've all heard the stories of, people getting a bag for their dinner after the game and there's a couple $100 bills in there. But the reality is we don't know. Now, I will never be a proponent for tax evasion. A lot of people that try to avoid taxes think that tax evasion is a sound strategy. It is not. And if in any way you are hiding money from the IRS, you deserve to get audited and pay all of the tax money on that. That is illegal and a crime. And I'm not a big supporter of this because you should report all of your income, and that way you can use that income to make investments that will then have deductions go on your tax bill. But the problem is if you ever try to make investments with money that isn't showing up on a tax bill, the IRS will be very quick to question where that money came from. And then you will end up owing taxes on it, penalties, fees, and interest. Not good. So with all of these taxes going up against an athlete, what options do they have to deal with this? Now, the first thing that I would recommend to any of these guys that are making serious money is to operate as a business. You are a business. You are a personal brand. You are getting hired and paid for your name, image, and likeness. And that is a brand, and you should build a business off of it. The first step in being able to start to get deductions and start to clean up your tax bill and your relationship with the IRS is to actually make it very clear what is your personal expenses and what are your business expenses. Now, from there, if we are operating as a business, we can make certain decisions. For example, we can make the S-Corp election, which, if you guys don't know, allows us to pay ourselves a salary and take the rest of the money as a distribution, which does not face self-employment tax. Now, as an athlete where you are heavily seen as the entrepreneur in your business, you can only take so much as a distribution. You have to be very clear how much you're taking in a reasonable salary, because at the end of the day, your reasonable salary is saying how much would you pay somebody else to do what you're doing, which is likely a very high portion of how much income that they have. So for example, we could have a dentist that is making 500 grand a year from his business. We could say that that person is making, say, 200 grand from his salary and then 300 grand as a distribution. Now this saves almost $45,000 in self-employment taxes, but it is very clear that if you were to hire another dentist, you would pay them a salary of $200,000 and the IRS could give that a thumbs up. However, for an athlete, it's unlikely they would pay somebody else to do the work for only 40% of how much they are doing. So being careful in this, I would aim for a much higher percentage. Now, personally, if I was an athlete in the NIL space that was making large sums of money, the biggest thing that I would do is start things like a clothing brand and an online personal brand. One, because these are going to get you access to more types of income, and they do have to be in the pursuit of business because otherwise the IRS will flag all of this stuff as a hobby. But if you do all that, that gives you access to deductions. Now, you do have to work on these businesses and you do have to show proof of revenue. The IRS isn't going to let you deduct, say, $100,000 of business expenses and you had $2,000 of business income last year. You need to create a business. And on top of that, the IRS only allows you to take $5,000 in startup deductions in the first year to prevent stuff like this. So what can we do? Now, the biggest thing people need to understand about tax strategy is when you decide to make the commitment that I'm trying to lower my tax bill, what you are saying is, hey, IRS, I'm going to read your book, the tax code, that tells us how we can lower our taxes through all the deductions that are possible. And in return, I'm going to act in accordance to that. Because what the IRS is saying is they're saying, hey, instead of handing us all of your money, you can put it into these other vehicles that we see that benefit society, and that works just fine. And so, for example, if you get a brand new watch and a brand new Lambo, yeah, there are certain times where you can find those deductions to be acceptable. You can make those expenses acceptable. However, it's rare and the IRS scrutinizes it. There are specific things in the tax code that say luxurious purchases are not allowed as deductions. Not always, there is workarounds, but that's the general rule. And so all of the lifestyle stuff that you want to have is going to have to be framed a certain way if you want it to become a deduction. You have to make the decision, do I want to be an investor that wants to lower my tax bill and gain wealth in the future? Or do I just want to blow all this money away on fun stuff? It's really hard for me to make an argument to get your Rolex watch written off, although possible. So the decision that I would look at if I was a college athlete at this time making 6 to 7 figures of income is getting into real estate. Because if you're making 500 grand a year and realistically you're a college kid, you can live off of 25 or 30 grand, okay? You can look into taking a couple $100,000, investing it into a real estate property, and you can use the short-term rental strategy to actually deduct that from your active income. You can pair this up with a cost segregation study, which just means we're going to look at the house, okay, and we're going to see all the stuff in it, and we're going to determine how much stuff is stuff and how much stuff is house. Because when you buy a rental property, you are able to deduct the full cost of the building, not the land, over the course of 27 and a half years. However, there are certain things in the home that count as additions that you can write off in less amounts, meaning you don't have to wait 27 years to split up the cost of that. which means that you can get up to 15 to 40% of the purchase price of that property in a year one deduction. And then guess what? After that, you can decide if you want to add the rental property to your portfolio or if you want to keep it as an active rental, meaning still working on the short-term nature of it. Now, once again with this, the IRS wants to see that you are acting as a business. So this average stay has to be less than 7 days or at exactly 7 days. And you need to have people that are actually tenants, which also is important from a business perspective because if you're not getting income, then you aren't going to be able to actually make any money and cover the debt payments. But more importantly than that, you need to be really smart about how you buy, and you need to surround yourself with a good team to do this for you. The best investments that I could see a college athlete make right now are not oil and gas or certain stocks or bonds, but it is into a good financial advisor and tax strategist, because that money that you're making now isn't going to last forever. And the reality is most of these guys are not going to go to the NFL. And there's a million other strategies that we could talk about to lower your taxes. But the more important thing that I see is that these people are making a very extremely high amount of income for a short period of time. Because a lot of them, if they don't go to the NFL, they're not going to continue to make that money. So the two things we got to do is capitalize on this money now. We have to make this money last, use it to invest. And then on top of that, see how we can make the money, make us more money in the future. This is why I'm such a big advocate of things like starting a personal brand online, because you might be done playing football, but you still have the personal brand going. And that means you can still get access to the sponsorship deals you were getting before. So to wrap this thing up, okay, NIL athletes are getting taxed as a 1099 contractor, okay? And they have limited options in how they can treat their income as business income and therefore get access to business deductions. However, if you invest properly with a sound strategy and you plan that income to be for a long time and actually use that money in the pursuit of business, then you can gain deductions that will lower your tax liability. For all these NIL athletes out there, I hope that they make it to the NFL and make it, but more importantly, because so low and so few of people are actually getting to do that, I hope that these athletes use this income to create generational wealth for their families, because likely they're going to end up in normal jobs once they're done playing football, making 80 to 90K a year. So if they're making 700 grand when they're 20 years old and they're going to be making 80 grand a year when they're 25, okay, well, let's see how we can use that 700 now so we are not just like everybody else when we get 25. As always, thank you guys for watching. If you found this video helpful, make sure to comment below and subscribe. What insights did you gain from this? What questions do you still have? I'm here to answer everything. And once my firm gets launched in the next year or two, we are going to be specifically helping these athletes and more importantly, other 1099 contractors reduce their tax liability. As always, this is not investment or tax advice. Make sure you seek out your professional for your specific situation, and I'll see you in the next video. Thank you.